Consumer Price Index (CPI) data indicates a 3.2% price increase over the past year. However, prices feel much higher than the reported amount. And because of this discrepancy, Americans are skeptical about the accuracy of the CPI figures, and for good reason. A recent report from the Bureau of Labor Statistics, BLS, questions the reliability of the data based on 5 factors. First is weak response rates. The responses used in the calculation are still below the 2019 level. With response rates dropping as low as 30%, the reliability of economic data becomes increasingly questionable. Second is the data collection method. According to a Bloomberg report, the BLS adjusted its data collection methods during the pandemic, relying more on phone calls, emails, and online surveys. And this shift has led to lower response rates, raising concerns about data accuracy and necessitating adjustments to compensate for potential errors. Third, the CPI calculation underwent adjustments in the 1990s to consistently show lower price inflation. The Boskin Commission, appointed by the Senate, recommended these adjustments to address perceived bias in CPI computation, ultimately leading to changes aimed at generating smaller inflation figures. Fourth is the subjectivity inherent in CPI calculation, which raises doubts. The BLS determines CPI by analyzing the prices of a basket of goods, but the selection of items and their assigned weights significantly influence the final CPI value. Fifth, the reliance on surveys for CPI data collection poses challenges. Rather than employing sophisticated scientific methods, the BLS gathers information through surveys, introducing potential inaccuracies due to respondents' biases or incomplete data. The BLS has struggled to obtain sufficient survey responses, further compounds this issue, with completion rates dropping below pre-pandemic levels. All these factors should be enough to make us skeptical of government economic data. The potential for data manipulation or inaccuracies underscores the importance of proper evaluation and interpretation of economic indicators. Even the BLS itself admits the accuracy of the data is questionable. It says on their website that the failure of a data unit to respond at either the data collection stages or estimation stage represents a loss of statistical information, which dilutes the accuracy of the sample. But there is more. Let's take a closer look at the latest jobs report. For the third consecutive month, the American economy has added significantly more jobs than economists predicted, with 303,000 new jobs in March alone. At first glance, that sounds positive. However, as Ryan McMaken explained recently, a deeper dive into the data reveals a less rosy picture. Almost all of the newly added jobs are part-time, while full-time employment has actually been declining since December of last year. McMaken points out that the number of full-time jobs year over year has even dipped into what could be considered recession territory. Moreover, the majority of these new part-time positions are being filled by immigrants, many of whom are in the country illegally. Since mid-2018, there hasn't been any job growth for native-born Americans. Although employing immigrants isn't detrimental to the economy, the influx of new foreign-born workers is masking the employment challenges faced by the native population. Additionally, nearly a quarter of the jobs added were in the government sector, which is significantly higher than the usual 10 to 12%. Like government spending that inflates economic growth figures, this surge in government hiring might boost the official job numbers, but detracts from the economy's actual productivity. Economists like Daniel Lacalle believe that the U.S. is already in a private sector recession, obscured by government spending and hiring that inflate the official data. The unavoidable recession, a result of a decade of interest rate manipulation by the Federal Reserve, intensified by their drastic measures during the pandemic, seems evident in the ongoing decline in full-time employment, supporting Lacalle's viewpoint. Job numbers tell only part of the story. The stock market has also been quite volatile recently. Interestingly, these fluctuations are not due to changes in consumer needs or the introduction of new technologies, but rather they hinge on statements from Federal Reserve officials about the central bank's plans for the year. Meanwhile, prices remain high and continue to climb, frustrating even some of President Joe Biden's staunchest economic supporters. Our money has lost about 20% 10% of its value over the past 4 years, and there's no sign of this trend reversing. This devaluation is causing real financial pain. Yet, instead of addressing these economic challenges or acknowledging their part in causing them, many politicians continue to act as if everything is fine. The lesson to be learned: don't take economic data at face value. Just because the government says we're doing great won't make things okay. It's better to know the truth and prepare for the worst. Dig deeper and make sure you understand how things are going to affect your future. If you want to continue learning more, please subscribe to Noble Gold's YouTube channel. And if you have something to share, please leave it in the comment section. This has been Ivory Hecker for Noble Gold News. Thank you.